I'm Tariff, Chief Economist, welcoming you to our March Macro Insights live stream. And I'm alone here in Singapore, physically, but I'm joined from Hong Kong, connecting live via WebEx, Ji, our China Chief Economist, and Nathan Chow, our Senior Economist for China and Hong Kong. Hi, guys. Okay, maybe there's something wrong with the audio. We can really hear them, but I can see them, and they will be connected loud and clear when their time comes. So let's get going with the presentation slides. Just to give you a flavor of the title, Tariff Storm. There's been a proverbial storm of tariffs threatened and actual, and sometimes scaled back over the last month. We sort of expected some degree of mayhem out of the Trump administration, but not probably like this. So I will spend about 20 minutes talking about the US economy and the implications around the tariff storm, so to speak. There is not only US-related developments that matter. There are other things going on in this world as well. So we decided this month we will not just focus entirely on US and tariff-related issues and US economic outlook, but also bring in our colleagues from Hong Kong, with Mo talking about the China, given his 2 sessions recently, and Nathan to talk about Hong Kong, given the budget that was passed recently. There's a lot going on in our part of the world. Not all of that is contingent on what happens in the US. I think that's an important differentiating factor in our research. It's not just about only looking at what's happening in the US. So let's, before getting going, let me just point out the obvious, as we do every single month, that we will be happy to take your questions. On the screen, you have the QR code for Pigeonhole. Any problem with scanning the QR code, just go to the website, type dbs.pigeonhole.at, and enter the passcode macromarch12. It will accomplish exactly the same thing. It'll take you to the Q&A screen, and you can either vote for existing questions or sending new questions. We will have, hopefully, at least 10 minutes to look at your questions and answer them toward the end of this Macro Insights presentation. All right, the macro backdrop. I have on the screen 2 successive pages, as you can see, detailing the various tariff measures that the US administration has announced. And this is taken from the website of Tax Foundation, which is assiduously putting together the various tariff-related developments, country by country, what kind of tariff, what's the product, how much money is at stake in terms of imports coming from that product to the US. All of that is there, but I can assure you, by the time, say, you download our presentation and read it, some of it will become outdated. Think about what happened overnight. I mean, we're talking to you on the 11th of March, 12th of March. In the 11th of March overnight in the US, during the course of the day, Donald Trump more or less went ahead with additional 25% of steel and aluminum tariff on Canada. But by the time the day was over, he had sort of removed them because the governor of Ontario had chosen to reduce some electricity tariff to the US. So this sort of fog of trade war is rather dense. And anything we try to put on a static page is at risk of becoming outdated pretty quickly. But I think just looking at the content on these 2 pages sort of tells you the seismic developments related to the US on trade and tariff. Measure after measure, some of it is imposed, some of it is postponed, some of it may not happen at all. But that's the way companies and governments around the world are dealing with the US at this juncture. A lot of noise. Probably not all of it is consequential, but largely it is, and it's certainly having an impact. We're going to talk about what kind of impact it's having in the next few slides. So firstly, the net impact of the actual tariff imposition already has taken the average tariff on US imports to the highest level seen since the 1930s. This is a remarkable chart that I have on the screen, and hopefully most of you dialing into this call are not looking at a tiny screen, but have a large iPad or a computer screen to look at, because this chart is certainly worth examining in detail. Again, our friends at Tax Foundation have prepared this thing, looking at 2 centuries of tax rates imposed by the US on its imports. US has flirted with high tariffs in the past. During the time of President McKinley in the late 1800s and early 1900s, US tariff rate on dutiable products was 20%. on average, but on certain products was up to 50, 60%. Then also during the famous Smoot-Hawley tariff regime, average tariff on imports was raised substantially. You can see that peak as well on this chart. Since then, we had, since the 1940s, basically, 75 years of globalization, steady decline in import protection. And in the last couple of decades, U.S. has had negligible tariff on its imports. Now, that's all behind us. Whatever Trump did in his first term was a tiny blip on this chart. What he has done in the last 2 months is no longer a blip. It is substantial. It is noticeable, even on a 200-year chart like this one. And chances are, by the time we come back to you a month from now, that line that we have on the far right hand of the axis probably be even a little higher. The spike might be even a little bigger by the time the dust settles around this, if at all, in the 4 years of Trump, the dust ever settles. The noise is hurting sentiments. Let's sort of look at a few gauge of sentiment. What you have on the screen right now is the University of Michigan survey. There are several thousand households that the University of Michigan surveys on a regular basis. Numerous questions are asked to them about inflation, about job outlook, about wages, about their confidence about the outlook, all of those things. We have picked 2 of them. One is consumer sentiment. How do you think things are going to be looking ahead? And then the other one is inflation expectation. Where do you see prices going over the next 12 months or so? As you can see, there's been a seismic change in people's expectations in the last few months since Donald Trump became president. People are sort of bewildered by what's happening in the U.S., whether it is DOGE-related activity, cutting the size of the federal government in a rather dramatic manner, or all these storm around tariff. It is certainly affecting people's outlook. They don't really know where things are going to go, but they don't like it because they're just overwhelmed by the noise. As a result, they are a little more gloomy about the outlook. They're not as gloomy as they were, let's say, during the pandemic times, but they're certainly getting a bit nervous about what's out there. And then when you think about their sort of expectations of inflation, that's again jumped up. So in a near-term horizon, they do think the tariff measures that Donald Trump is trying to implement will have rather dramatic impact on inflation. This is not good. This is telling you that people expect jobs to worsen and prices to remain high. It's almost like worst of both worlds. When we talk about the fog of trade and tariff war, most of the fog is related to policy uncertainty. What will be the U.S. policy vis-a-vis China with respect to its exports to the U.S.? What will be the U.S. policy vis-a-vis Canada, Mexico, European Union, India? We really don't know. And that point that we really don't know is beginning to reflect on the economic policy uncertainty. As you can see in this chart, this is maintained by, it's a outcome of a paper that was written a few years ago, and the St. Louis Federal Reserve in their FRED database updates it on a daily basis. And we see that economic policy uncertainty is basically the second highest on record, higher than it was during the global financial crisis, and almost as high as it was during the really, really confusing, uncertain days of the COVID pandemic. I think, just like I said earlier with respect to average tariff, that by the time we come back to you a month from now, it'll be higher than where it is now. I think by the time we come back to you a month from now, this chart will be even higher, probably the highest ever reading with respect to policy uncertainty. The data is also not just about surveys and expectation and uncertainty. There's some actual things going on. We've seen pretty weak retail data coming out of the U.S. Sales have been weak. When we look at some other sort of sentiment surveys from businesses, they have been poor. Certain data around investment has been poor. So the Atlanta Fed nowcast, which is the real-time measure of estimating current quarter GDP, has gone through a very seismic switch over the last 2 months, from tracking almost 4% growth for the first quarter of 2025 to now tracking a contraction of 2.4%. That's the kind of change we have seen the economy provide when it is dealing with so much uncertainty. If you are expecting things to be poor outlook-wise, meaning growth will be poor, jobs will be poor, wage growth will be anemic, well then you probably will be expecting the Fed to start cutting rates and helping the economy. And lo and behold, compared to where things were 8 weeks ago to now, there's been a substantial downward shift of the yield curve. The red two lines you have on the screen represent the U.S. yield curve. The dotted line is where the U.S. was at the end of 2024, and the solid line is where the U.S. is now. As you can see, the long end of the curve has rallied very, very rapidly. 2 months ago, I thought maybe long end is heading toward 5% and higher, but now we're saying low fours as far as the 10-year yield is concerned. I'm not sure this is where the market will settle. I think the risk is the rates could go even higher again on account of inflation. And speaking of inflation, let's look at the following slides. Well, actually, before looking at inflation, just want to point out what follows from that slide on fixed income market rallying in expectation of rate cuts. So there you go. The rate cuts are now being priced again for 2025. Just a couple of months ago, the market thought at most 50, but more likely probably only 25 basis points cut by the Fed in 2025. Now it seems like the market thinks, forget about all that. Let's go back to the pricing that we had in late October, November of 2025. 100 points perhaps of rate cuts this year. I'm not sure about this. This is what the market pricing is. I think the Fed will probably be able to cut twice, not more than that, even if the economy starts showing signs of weakness. And the reason for that is the following. Inflation remains a worry. You have on the screen right now ISM Manufacturers Survey, which is a pretty good predictor of where core PCE inflation is going. As you can see, it picked up a lot in the COVID times, long before the actual rate of inflation picked up, and it also subsided pretty dramatically in late 2022, early 23, and lo and behold, a few months later, core PCE started to drop pretty substantially as well. So the fact that that line has again turned upward, and in the last couple of months has seen substantial gains, makes me worried that at the best case, core inflation will be flat going forward, 2.5, 2.6, kind of like that, or it'll go higher. I see no scenario under which they go lower. More visualization on inflation is the relationship between money growth and CPI inflation in the US. Both CPI and core seem to lag money growth. So if today money growth is 5%, and it is significantly higher than where it was a couple of months ago, I would argue in a 12-month horizon, inflation will be higher. This chart is a chart where we have sort of done a little bit of moving the data around. We have M2 of the US, broad money, with a 12-month lag being plotted right next to what's happening with CPI and core PCE. As you can see, if we look at the recent trend in money growth, which is growing at a close to 5% on a year-on-year basis, that seemed to be consistent with definitely higher PCE and headline inflation. I'm not going to say that this is an absolute relationship, that I can estimate an elasticity or a beta out of this relationship, but I can certainly point to the directionality, and that is unambiguously upward. A little more on inflation. This is a survey that the Federal Reserves of New York, Kansas City, and Philadelphia do for their respective districts. And they go out and ask companies, what are you doing in terms of, how much you pay for your inputs, how much you get for your sales. And what people are saying is that both prices received and prices paid have gone up substantially, again, over the last couple of months, not before that. Small business survey, this data, unlike the previous slides that I've shown you, it does not run all the way through February. I don't have the February data. This one runs all the way to January. I'm really curious to see what happens to companies' plans of raising prices or already raising prices when the survey data comes out for the month of February. All right, so that's the inflation story. Let's also point out that despite the fact that the Elon Musk-led effort to fire a lot of federal workers has really commanded the headlines, data through February suggests that it hasn't really dented the labor market dynamic with respect to wage growth or unemployment rate. They remain more or less steady in the low fours, 4.1, 4.0 month to month. That's the good news. And the other part is that, although the Doge-related stories are creating a lot of headline, that doesn't really determine unemployment in the US in the macro overall sense of the word. Why? Because most jobs in the US are created by the private sector. So although, as you can see on the chart that I have on the screen right now, the green-blue bar chart, that public sector job creation has been certainly more robust now than it was during Trump 1.0, the Private sector job creation has been even more robust and very, very impressive. So it's 5 times the public sector jobs on a month-to-month basis, and it is growing comfortably. And I think that we will probably see decent demand for labor, and some of the people who are getting fired by Doge will probably be able to find some opportunities. Not all. It's creating distress. It'll have a negative impact, all these firings, but some people will be able to join the private sector, which remains vibrant, and which certainly is in the market for looking more talent. On the currency space, very interesting divergence going on right now. We have the G10 currencies sell off substantially against the US dollar, whereas gain substantially against the US dollar, where emerging market currencies have lost quite a bit of their value since the US election, and they haven't necessarily rallied in a big way against the US dollar, despite all the different macro developments happening out of the euro area. So what's happening with the euro and the yen in particular, the 2 big G7 currencies against the US dollar, they're both appreciating for slightly different reasons. Europe, because it seems like they will go for a big pump priming of the economy, that their fiscal largesse will prevent the ECB from cutting a lot of rates. So they may sort of have a rate differential or significant narrowing of rate differential vis-a-vis the US dollar in the coming months and quarters. So the euro has rallied around that. In the case of Bank of Japan, not necessarily Trump, but they have been talking about raising rates for a while. And given the recent developments of the last few months, they certainly are doing more to bring to the fore the tightening of monetary policy or normalization of monetary policy related work. So the yen has rallied, the euro has rallied, and as a result, G7 currencies, G10 currencies have rallied against the US dollar. Can't say the same thing about emerging market currencies. They may also be sort of waiting and seeing what happens, but on the policy front, policy space front, they don't have that much ammunition. They spent a lot of that during the pandemic. Their currencies remain rather listless against the US dollar. Speculative position on the US dollar has also changed quite dramatically. Just a month ago, maybe 5 weeks ago, we were talking about how we haven't seen any time in the recent history there being so many people who are long the US dollar. Well, that romance has ended, and we're now beginning to see the whole chart on the speculative position, not US dollar position, all begin to turn south. Everybody's nervous. Everybody wants to know what's going on, and they're not necessarily keen on holding their savings in US dollar. They're doing other things. That, again, is having a bit of a negative impact on the dollar outlook. Now, the key question, the trillion-dollar question, is not what's happening with the US economy. The trillion-dollar question is what's happening with the markets, because that has far bigger global ramification than the likelihood of some soft patch in the US in the first quarter. Now, when we talk about financial stability in the context of the US, we have to begin by talking about the stock market, which, despite the recent sell-off that we have seen, is in sort of stratosphere with respect to valuation. As you can see in this chart, fixed volatility has picked up, S&P has corrected, but compared to the gains that we have seen in the last couple of years, it's just a drop in the bucket. We are also seeing in terms of alternative assets like Bitcoin and crypto space, again, some degree of sell-off, but again, compared to the historical trend, they're still extremely expensive. During Trump's time, Bitcoins hung around 60,000. After ETF-fication happened with respect to cryptocurrencies, it became even bigger a player and bigger punting source for global investors. It's corrected quite a bit in the last couple of months, and I think some people have been taken aback by how quickly it's gone from well over 100,000 to just about 80,000. I think it remains a question as to how quickly these things can be managed. But for the time being, Trump remains a cheerleader of crypto assets, particularly Bitcoin, talking about setting up strategic reserves and so on. That might bring the crypto prices back to some extent at some point this year. But with respect to the first slide again, S&P 500 and VIX volatility, I'd be very careful of picking and choosing, especially since for the first time in many, many years, we have decent alternatives out there, whether it is European energy stocks or defense stocks or Chinese electronics companies. They all provide very interesting valuation proposition. You don't have to go in there for 10 years. You can probably realize some of your gains in the very near term. Okay, this is my final slide. After this, I'm going to hand the baton over to Mo. To me, what are the big risk factors for the rest of the year? Now, firstly, and this probably is my highest probability scenario, is stagflation. Now, by stagflation, we don't necessarily mean the 1970s style, really, really terrible recessionary outcome and really terrible double-digit inflation. We're not talking about that. but we certainly are talking about growth being below trend and inflation not going anywhere near the 2% mark that the Fed tries to convince everybody that it needs to see before it can cut rates. So the risk of sticky inflation, just as weak demand, kind of a worst of both world scenario, is certainly on the cards. I will assign that a good 30-35% probability for 2025. Bond market vigilance. There's a lot of talk about cutting spending, but these things are pinpricks in my view. They really don't address the meat of the U.S. budget, defense, Medicare, Medicaid, entitlements, and so on. It doesn't really seem to me that despite all their big talk, the Trump administration is really ready and able to do that bidding. And if they don't, then I think there is some questions about what happens to the bond market. Now, let's also be very clear that the U.S. is not a very high revenue jurisdiction, nor is it a very high expenditure jurisdiction. But the stereotype is that they are, and they're like Europe. They're not. They're much, much lower and a smaller government size than Europe. But they have added up a lot of debt. They have a lot of issuances. There's refinancing risk at the short end, long end, and the market's capacity to absorb all those flows certainly is being questioned. So the bond market vigilantes may want to push the yield up. The bond market vigilantes may want to find ways to be long the dollar again. But I think people who are sort of thinking about slightly broader time spectrum, these should be more like noise than reality. But again, we follow the market on a day-to-day basis. It's hard to avoid all the noise, and the likelihood of U.S. yields jumping toward high fives, maybe even toward 6% on the back of stagflationary risk, I wouldn't put it past it. The risk of some big long-dated bond issuance auction not getting historically strong demand, I think that's possible too. So we'll keep the stagflation and the bond market vigilance risk simultaneously in our minds as we sort of traverse through the rest of the year. Then the more extreme scenario, which is forget about all these brinkmanship and little things here and there. The U.S. economy was probably sputtering even in the final months of Kamala Harris as a vice president and then a presidential candidate, and certainly sputtering now under the leadership of Donald Trump, although he's trying a lot to get businesses excited. So I think that 1 quarter of negative growth, quite possible. 2 consecutive quarters of negative growth, which sort of justify recession, not too sure about that. I think that there was a lot of underlying momentum coming from 2024, which is still there in the U.S. with respect to helping the economy's outlook. I wouldn't read too much into the recessionary doom camp, but certainly growth slowdown just as inflation gets sticky, very much on the cards. Finally, financial stability. I've been doing a lot of reading on this issue, and I've been reading Fed's report on U.S. financial sector stability published in late 2024. There are a couple of important points in the Fed Financial Stability Survey that we need to keep in mind in the context of 2025. First is valuation. The Fed was worried that asset markets were extremely highly valued, and therefore the risk of sort of a hard landing just around stock prices is there. By the way, markets have gone even higher since the article came out by the Fed. But the fact of the matter remains that the authorities are a bit nervous about the valuation, sky-high valuation of these products, and the risk of not having an orderly adjustment to lower growth, lower PE equilibrium. It might be a lot of disappointment from investors who have accessed these products or these ideas through exotic products, and they may be impatient or they may be panicky with respect to liquidating their positions. But high valuation, which invariably leads to a big correction, certainly a key financial sector risk for the U.S. in 2025 and perhaps in 2026. The Fed, in its financial stability survey, also says that hedge fund leverage has gone up a lot. It's in the same level or the highest level since the 2008 financial crisis. So I sort of worry about the big house of debt that's been built around the world, public sector, private sector, which is being serviced at fairly high interest rates right now, whether that can bring some financial stability issues. Fingers crossed, in my scan of the horizon, I don't really see anything that is of clear and present danger, but it's a danger nonetheless. The final point on financial stability coming from the Fed's perspective is the household balance sheet. That households burdened with high interest rates have been struggling, particularly at the low end of the income spectrum. So there's certainly credit risk manifesting at the bottom 20, 30 percentile of the students and households, people with student loans or mortgages or car loans and so on. They are sort of chafing under the high interest rate. And that certainly is a concern as we sort of traverse through the year, that rates may or may not come down, but for homes and householders servicing that debt, it has become quite a challenge. And now if you're on top of that, you add inflation worries coming from tariffs and immigration measure and tax measure, and on top of that, you add significant amount of constraint on the government's part to support the economy because of all the DOGE-related firing, it could be a source of concern. So that's where I'm going to stop for the time being. I'll come back and take questions toward the end. But right now, I'm just going to hand the baton over to Mo, who's been sitting patiently in Hong Kong to talk to us about China. Hi, Mo.
Hello, thank you.
I can hear you loud and clear. And Mo, whenever you want to go to the next slide, just tell me next slide and I'll click for you.
Oh, thank you so much. Next slide, please.
There you go.
Next one. Okay. No, the one before. Okay. The 5%. Yes. Okay. So I think just now Tama has been mentioning about this tariff storm, but how China rides through this tariff storm, actually, this has been in line with the three most asked questions, recently by the investors and markets. So what are the three questions? Number one, why stimulus last September? Why in January and February China has been pausing in stimulus? And number three, why in these NPC 2 sessions, China has been setting a very bold 5% GDP growth rate? So the answer to it, or say one of the major factors affecting all the answers to these questions, is about the potential tariff stall. So the first one, on the last September, by stimulus, at that time, China thinks, there will be US presidential election. They don't know what will be the result. There might be potential, trade tariff coming up. So this is only one reason. The other reason is back in August, China has been celebrating Deng Xiaoping's 120th birthday. This shows China wants to go back to reform and opening up to growth and development. So this is why we see why stimulus by then. Then the second question is, can it be sustainable? But markets are seeing in January, February, they have been pausing. Why? Because Trump was elected. Then markets are seeing is also for the Chinese government, they want to understand for the first 100 days what Trump is going to do, what kind of tariff they are going to put on China. So this is why they are kind of pausing. But does it mean China will have sustainability in terms of their stimulus? No. So this comes to the third question. It's about this 5% GDP target. So this is very bold. Given the downside pressure for the economy, inflation, property correction, local government debt, but also on top of that, we have the tariff. But why China wants to set up this? For us, DBS, last November, when we have our China outlook, we put the deep target at 5% because we believe and also we are very confident the government will carry out big stimulus, not only in monetary easing, but also in fiscal easing. They try to make sure not only for them to fend off this potential tariff storm, but also this year is the ending year of China's 14th five-year plan. They want to make a very good conclusion of this 14th five-year plan year, but also they want to make sure the start of the 15th five-year plan will have a good start. So this is why we see that setting up 5% GDP growth rate, whereas market consensus is only at 4.5%, LMI at 4.6%. Also, even for the new employment, is at 12 million people and a rate of 5%. But I think they are very careful in terms of inflation. They lower it down from the 3% to 2%. Currently, for the January data, China inflation was minus 3.7%. This inflation pressure is still within the system. But in terms of the fiscal deficit, you can see they are raising it from 3% to 4%. 1% up is equivalent to 1.6 trillion of RMB. They want to do more. If you see the second chart on this page, you can see in terms of what things they really want to do. You see, they want to boost consumption. They want to boost technology. They want to continue to be opening up. So these are the things, the focus. They know if they focus on these areas, that will boost the growth. That will be even better for China to be positioned in a position to fend off the potential tariff war. Next page, please. For this fiscal deficit, you may ask me, will China facing some kind of like constraints? Meaning, so China will go back to kind of like deleveraging. Because if you see the total fiscal impulse, if you add up all of this additional, stimulus, it will be around 9.8% of GDP. Then we can go to next page. So we actually see China's, in terms of the foreign exchange reserve is at 3.2 trillion, but the net reserve is at, over 799 billion. So 50% of China's external debt is in RMB denominated. So also China's central government debt is only 25%. So that means China's debt level is very sustainable. But it's just like at this juncture, in terms of the tariff, in terms of downside pressure for the economy, China needs to ease much more, especially from the fiscal side. But for the monetary side, we also see this in 15 years' time, China go back to the moderately loose monetary policy, whereas prudent monetary policy, meaning they want to act anytime, immediately to cut triple R or cut the interest rates. Next page, please. So given our communication, with the government, so I think markets truly wants to know what's China's stance on Trump 2.0, especially the potential tariff. I think it rests on three aspects. Number one, China is becoming much more poised and confident. Then you may ask me why. Why China is becoming more confident? Because China already has experience in the past 8 years with the US, and China has already been completing or say extending its supply chain, has been on the one hand is decoupling with the US, but on the other hand, China is recoupling with the rest of the world, especially Asian countries, Eurozone. So this is why China is becoming much more poised and confident. Secondly, China wants to take a stance, more negotiation than retaliation. One of the vivid example in the past 2 months is about US has been increased like 20% of tariff on China. This is about the goods impacted 525 billion US dollars. But China also tariff like 20%, but the goods impacted for the US is only 36 billion. Why? Because China doesn't want to escalate this potential tariff, frictions. So they want to downgrade, all this potential impact, negative impact. And thirdly, China wants to be more reactive than proactive. Why is that? This current administration, given our understanding, it's very hard for China to get even any of the context. So for them, the best position is whenever things come, they will just react. They want to downplay. They want to minimize all those potential negative. So this is something I think as investors, we need to bear in mind. Next page, please. Also, our team has done, next page, please. Also, our team has done analysis on the potential tariff impact on China's growth. So currently, the 20% additional tariff will knock off around 0.45% of the GDP. Then if it is 100%, it will be close to 2%. So currently, we are seeing it's like step by step in terms of the tariff increase. It's not like the 60% as Trump when he is doing the election campaign. If you look at the chart on the right hand side, you can see even for the Biden administration, whereas the Trump 1.0 for exports between US and China is up 22%, imports up 20%, trade balance up 21%. So this means no matter what kind of friction it is, the trade hasn't stopped. So hasn't even stopped between US and China. Next page, please. So one thing, is very worthwhile for us to notice. Back in 2024, China's trade surplus reaches historical high, US dollar 1 trillion. So this is 3.5 trillion of exports minus 2.5 trillion of imports. So this historical trade surplus adding to China's reserves make sure China has enough money. But on the other hand, we can see how China has been coupling with the rest of the world. Asian country becomes the number one trade partner with China, accounting for the trade share 16.1%, EU 14.6%, and US has been down to 14%. So this is where we see, even given all of these potential trade frictions, China's trade hasn't been really impacted. If you see by products, China, especially for electronics, for auto parts, for home appliance, all this, it has been up like 20%, over double-digit growth. So this has been very strong. What are they? They are the high manufactured products. So China has been very strong, and this will continue to show its strength. Next page, please. The other question currently markets has been asking is all about what's happening with tech. Will tech, this round of tech can add potential for China's GDP growth rate? I think given my observation for the DeepSeek back in January and until now, I think even for China, in terms of the AI innovation and etc., it has been shaping the world with another kind of picture. It is China's going to be like a leader in some of the areas, very much so. Whereas before, it's only a follower. On the other hand, China is also becoming like, open mode rather than before it's a closed mode. So if you know, the week before, DeepSeek has been doing the 1 week of open mode, sharing their codes. So that means they're much more confident. And the other one is about win-win situation. Before the competition within China is very, very competitive. So that's why we see all the prices are coming down. But now they want to collaborate. They want to do them all together. So one of the very interesting things back in January, February, even if we see the stimulus has been kind of paused to wait to see what Trump's going to do. But also the government has been meeting with the private sector leaders. They are all getting together. They want to make sure AI is being applied to all their sectors they are doing. It's not only from agriculture to industry, to like manufacturing, also like to even the services. So this is why China's mode in terms of tech is changing. And I think this is the start and it's very important. Even for the global robot industry, for one of the very leading company, Unitree Robotics, so they are accounting around 70% of the global production. So they are projecting globally for us, maybe in one day, one people can have three humanoid robotics. So let's see when we are going to see it. Next page, please. So for China, the biggest two risks facing China, one is the very weak aggregate demand. Inflation, just as I've been mentioning. So the inflation CPI is at minus 0.7%, but even for the core CPI is also going to negative. And PPI, this is producer purchasing index, it has been in this negative territory for over 28 months. So this means the DCM pressure is very high, and this reflects the overall aggregate demand has been so weak. The other data we can also look at is China's money supply. So the money supply data, so for the M1 growth, that is cash plus the demand deposit, it has been finally back to positive, but we see it's going down a little bit, close to 0%. So this is the money for the corporates and households they want to spend. So if it is not in positive, if it is not higher than the M2 growth rate, meaning both for households and corporates, they do not want to do the capex expansion. So we have to wait for that turning point for China's corporate demand is finally coming back. We are not there yet. Next page, please. For the ongoing property market correction, so we see for China's property market sales for the January month, it's down 9.1%, even though they are improving. But we are still seeing the sales is not really coming back, especially in the tier 3, 4, 5 cities. Tier 1 cities show some initial green shoots, but we need to see whether it can be lasting longer. Even for the residential inventory turnover in 80 cities by month. So on a 12-month moving average, to smooth out all those seasonality, it's still at 26.7 months, which is still much higher than the 18 months threshold they want to reach, or the 5-year average at 17. So in terms of this year, the government has to do more in terms of all these swap programs to make sure all this over inventory to be translated into public housing, etc. So for China in 2025 overall, we think besides big equity demand, property market correction, local government debt swap, but also on top of this tariff, China will have to ease much more, both in terms of monetary policy and fiscal policy. But on top of that, what we think is for the tech innovation, if they have more to be released, that will really boost consumer, corporates, even the overall confidence much more. So we are looking for that in 2025. Thank you. So over to Nathan.
Very much, Mo. Mo, if you maybe I keep you for 1 minute before we hand it over to Nathan. Very quick question.
Can you hear me well?
In terms of monetary policy easing, corollary of that is a weak RMB. Doesn't the U.S. want a strong RMB and a weak U.S. dollar? Wasn't that getting the problem with Trump as far as China is concerned?
This is a very good question. Yes, I forgot to mention. I think for here, for China, people always ask for RMB. Will it be a tool for China to fight against US on this US tariff? I think this, given my understanding and communication with the central bank, that will be the last resort or the last tool they want to use. So they want the number one thing for the PBOC is try to make sure RMB stability. So whatever they do, they want to make sure RMB on a relative basis to dollar can be relatively stable. Only to the last resort that no other options, they will depreciate, but they will depreciate on a degree much less than dollar. That's something they are really wanting to do.
We shall see. Thanks, Mo. All right, Nathan, 10 minutes to cover Hong Kong for you.
Okay, thank you. Thank you, Tamar. Thank you, Mo. As for the Hong Kong's economy, next page, please. We're expecting GDP growth to be about 2.5%. And in terms of level, Hong Kong has sort of restored the pre-pandemic GDP levels already. But in terms of growth, it is still growing slower than the average that we have seen between 2010 and 2019, which is about 2.8%. This year, looking ahead, obviously there are some challenges to watch out for. On top of tariffs, such as like weak retail sales and property sector, and the fiscal positions of the Hong Kong's government is also sort of worsening a bit. So, but the thing is that it is not all gloom and doom. There are also some positive developments, such as we are seeing improving inbound tourism. We are seeing obviously improving capital market development, especially the stock market. So let's kick off my section with a quick update on the export sector. As you can see on the chart here, exports in Hong Kong barely grew in January. It rose just by about 0.1% year on year. The main drag, I would say, was the Chinese New Year effect, because the US tariffs on China were not even in place yet back in January. So that was not the real issue. And there's actually a chance for a rebound in February, given what we have seen in the China's PMI numbers recently. But of course, as the year goes on, we will gradually start to feel the impact of those tariffs. But here is the big picture. The US is not as big of a player for Hong Kong's exports anymore. It now accounts for just like 5%, 6% of total exports. Like 15 years ago or 20 years ago, we are talking about 20-something, 30%. But right now, we're just talking about 5%, 6%. Mainland China is the dominant market. The stimulus package that Mo just talked about in mainland China should boost domestic demand, which in turn will support Hong Kong's export. And of course, the growth in the broader region will also help, especially the steady demand from Southeast Asia countries, right? Plus the fact that demand from other emerging markets should also help offset some of the losses from the US as well. So there are challenges ahead, that is for sure, but this is not a collapse. We are still expecting modest export growth this year. Moving on to next page. Consumption improved slightly recently in January. Retail sales are still down, but the drop is slowing. So the contraction is narrowing. Part of that thanks to government policy measures. The government has, for instance, relaxed visa rules for Chinese residents, letting tourists from China enter multiple times. They also made it easier for visitors from Southeast Asia's countries to come. And you can already see the impact, in major shopping areas. They're definitely busier. You are seeing more people. And there are also more Japanese and Korean tourist groups recently, because the Hong Kong government has done a lot of promotion campaigns over the past 1 year, and we are now seeing the impact. All right. And in the budget speech 2 weeks ago, the government announced more than 1 billion Hong Kong dollar to pump up tourism. For instance, they're going to hold some big events like the National Games of China right here in Hong Kong. And Coldplay, the famous rock band, is coming to Hong Kong in April. So that is expected to bring in more visitors, bring in more spending. Okay, so tourism is helping. That is a good thing to see. But having said that, we are not talking about a huge retail rebound in 2025, not this year, because at the end of the day, mainland Chinese tourists are still the biggest driver of Hong Kong's retail, and they are spending less for 2 reasons. First one is that the income growth in China has slowed, so they have less to spend. And the second reason is that their habits are also changing. They're more into experiences like food, like a local tour, and they're gonna have some sightseeing rather than shopping, especially for luxury goods, watches and bags, right? So there's winners and losers against this backdrop. For instance, catering is holding up well. Restaurants, F&B, people are still eating out, but jewelry, watches, department stores, they're sort of struggling. Jewelry sales are still, for instance, 30%, 40% below the level that we've seen in 2018. Okay, and next slide, please. So it is not just tourists. Local people in Hong Kong are also changing their habits as well. More Hong Kong people right now are heading across the border to Shenzhen, to Zhuhai on weekends for better deals, cheaper foods, more spaces, So the bottom line is that retail sales should grow this year, but we are not expecting a big comeback. We are talking about low single-digit numbers, so like 2 to 3%. That is in line with the projection made by the Hong Kong Retail Association that I've met like a few weeks ago. As far as loan growth is concerned, next slide, please. The biggest uncertainty is how much the Fed will cut. So right now, the market is expecting 2 to 3 rate cuts this year, just like what Tama has just talked about over the past few weeks. Both surveys and real data in the US have been showing a slowdown in spending and investment, mostly because of the growing policy uncertainty, right? So that's why the market is sort of expecting 2 to 3 rate cuts this year. So if that turns out to be true, HIBOR in Hong Kong will edge down further. So that is a good thing. That is a positive to loan growth. And on top of lower interest rate, the HKMA is also stepping in. It's helping the local firms. For instance, they have cut capital buffers, and they have also brought back the loan concessions to help SMEs to borrow more easily. I would say that is a big help because in 2024, a lot of SMEs struggle to get loans due to tighter lending, due to higher rates, due to lower credit limits. And the falling property prices made it even harder because many SMEs in Hong Kong, they use property as collaterals when borrowing from banks, right? So what the HKMA does will definitely help. And speaking of property, next slide, please. We are actually seeing some positive signs recently, like a pickup in transactions, especially after the government eased mortgage rules such as higher loan-to-value ratios and debt servicing ratios, et cetera, et cetera. So that would definitely help. And also the talent program is also bringing more people to Hong Kong. So that is also boosting demand, and particularly from mainland buyers, because they are making up about half of primary transactions, as you can see from the right chart. So that is a good start. But for a real rebound in prices, I would say we need to see a faster, stronger absorption rate. Because right now, as you can see on the next slide, I have a chart for inventory. Unsold inventory is a 20-year high in Hong Kong. Okay, so that is a major drag in terms of prices, because developers got to price their new projects competitively to clear their stocks. So that is their priority this year, or probably next year. And at the end of the day, it all comes down to fundamentals. We need a stronger economic recovery to getting the housing market back on track. All right. So, in terms of when it comes to the stock market, we are seeing some encouraging development here. We have been seeing a huge jump in daily turnover since January. The Hang Seng Index is up by more than 20% so far this year. And a lot of this surge is thanks to DeepSeek. It has basically kicked off a big re-rating of Chinese stocks, bringing a lot of money into the Hong Kong's market. So that's why the Hang Seng Tech Index has shot up even more than 30% this year so far. Okay, and PE ratios have also jumped from something about 22 at the start of the year to right now about 25. So you can see the surge in Alibaba and Tencent, right? But the thing is that even with these huge gains, Chinese tech stocks are still cheaper, or I should say way cheaper than the Magnificent Seven in the US, which are trading at an average of about 30 times, even after taking into consideration of the recent correction.
Nathan?
Right? So it makes sense. Yeah.
Let me interrupt you for a second. I want to put a question on Hong Kong on the screen for you, okay?
Yeah, sure.
So this is related to the fiscal situation. That are you worried about the fiscal outlook, and do you see any link between the fiscal situation and the Hong Kong dollar peg?
Okay, Hong Kong, in terms of fiscal situation, it has been running deficits for 3 years straight since 2021. And in 2024, 2025, the deficit forecast is about 2.7% of GDP. And the big reason for this is a sharp drop in land premium revenue, which is still a major concern, okay? Because we won't be seeing a meaningful recovery in the property sector until something like 2026 and 2027, okay? And the ratio of fiscal reserves to monthly public spending has also dropped quite a lot, from over 28 months to 10 months right now. But just to clarify, fiscal reserves and FX reserves are not the same thing. So when we are talking about the Hong Kong dollar peg, the FX reserves matter instead of the fiscal reserve, right? Because they are not from the same pot of money. And right now, the FX reserve is still covering more than money supply, more than M1, okay? But of course, if the deficit keeps growing and becomes a long-term issue, that could hurt the government's credibility. But the thing is that we are seeing the government in Hong Kong is reacting proactively to tackling the deficit. For instance, they're taking steps to, the cutting public spending and implementing some other austerity measures as well. And they are also planning to issue more bonds. And the good news to Hong Kong is that Hong Kong's debt number is low. The debt burden right now, in terms of debt to GDP ratio, is about 9%. That is way lower than the global average for developed countries or developed cities, right?
Thanks,
and
Nathan,
on top of that,
we're running out of time.
Yeah.
So I'll just jump to a China question for Mo right now. Mo,
okay, sure.
Several questions on the growth issue. That this 5% growth that we have, both the authorities' forecast and our forecast, is it really achievable in 2025?
I think it is achievable. It's not only by the Bureau of Statistics. They can really set the number, but I think on the ground, given our checking, especially most recently, we've been talking with a lot of multinational Asian CEOs that think their activities are actually improving robustly. It's varying from the consumer products, luxury products, from cars, like EVs, the tires, etc., etc. So one of the data we see for EV, it has been up over 70% of sales, from this month vs last month, and also for the commercial vehicles is also up 20%. So on the ground, we are seeing the confidence is finally coming back, especially for the deep seek, but also for the humanoid robotics, but also for one of the very popular animated movie in China. So all of this showing the on the ground confidence is coming back. That will support the growth, from the bottom up.
Very good. Excellent. It's been a long time since I've heard such optimism on China's outlook, so good to hear that. And also, one of the charts that Nathan was showing, the contrast between NASDAQ and Hang Seng, I can't remember. Maybe it's been 10 years since we were able to show a chart like that. So very interesting. All right, again, we have time for just one final question. This is on the U.S. I'll take it. There's an ongoing theory that Trump is pushing and posturing on tariff to slow or crash the U.S. economy, which would then lower rates for their upcoming refinancing. My thoughts, I don't think he's posturing. I think Trump is very serious about tariff. I don't think this is just a game for him. He really wants to remake U.S. manufacturing for the long term by creating these tariff walls. I think some of it could be a bit of a back and forth with allies maybe, but I think the idea that somehow he'll strike these big grand bargains with a bunch of countries and there'll be no tariff, but by then the damage will be done and there'll be a recession, and he'll win that game because that allows him to do some cheap refinancing of U.S. debt. I don't think so. I think that there is no free lunch. If the U.S. is serious about low interest rates, they will have to go through serious fiscal consolidation, and that will not be done with Doge type activities of firing few people here and firing few people there. They would have to address defense. They would have to address entitlements like Medicare, Medicaid, Social Security. I don't think Trump has the political appetite to do any of those things. But short of that, I don't think the U.S. will get lasting low interest rates, even if it creates a recession. That's the problem right now. We have inflation-related problems. We have debt refinancing-related problems. All of those things would require the economy to slow substantially without tariff, with cheap imports, and with meaningful, durable fiscal consolidation. I don't think using tariff as a game and crashing the economy will buy the U.S. sufficient time to refinance its debt. Even if the U.S. is in deep recession tomorrow, I don't think there'll be buyers of tens of trillions of dollars worth of U.S. debt if the interest rate on that is like 2%. I don't think that's going to happen. The world is a very different place today than it was 5-7 years ago when you could issue sovereign bonds at very low interest rates, and because it was zero interest rate all over the world, people still bought it. It's not very like that at all. And by doing this tariff war, Trump has killed so much goodwill. I don't think that's going to help, again, in terms of galvanizing global interest in U.S. sovereign assets. So the storm will continue. I don't think it is ephemeral. It'll last. We should just guard ourselves for it. In the next live stream, we'll talk a little bit more about the rest of Asia and how it is dealing with the tariff storm. But until then, thank you, Mo. Thank you, Nathan, for your support in the live stream. Thanks to our team here at Spark Studios for their support. Sometimes the technology is a bit glitchy. Bear with us. We're refining these things and we'll get better in the future. So until April, everybody, stay healthy, stay safe. Thanks for joining our live stream. Bye-bye.